Accounting Standard Board of ICAI, I, CA Shweta Goel, extend a warm welcome to all of you to the fifth session of our webinar series, Demystifying Sustainability Catalyzing Growth. Today's session is centered around the critical theme of carbon accounting. We are honored to have with us our chairperson, our vice chairman of SRSB board, CA Preeti Savarji, our chairperson, and CA Sanjeev Singhal ji, our vice chair of SRSB board, and our esteemed speaker, Ms. Shreya Kalira ji, and our moderators for today's session, CA Veerav Nitin Dedia ji and CA Harshad Shah ji. Let us now Harshad Shah ji to kindly take the session forward.
Thank you so much. Let's move forward with our introduction to our speaker. So as you are aware, the session on carbon accounting will be conducted by Ms. Shreya Kalra. If I could introduce the speaker in few sentences, I would say that Shreya Kalra is a seasoned sustainability and ESG professional with over 5 years of experience in environmental impact assessment, green gas accounting, and corporate sustainability reporting. Currently, she is serving as a manager at ESG at Incorp India. She specializes in aligning corporate sustainability strategies with a global framework such as GRI, TCFD, IFRS, and SEBI's BRSR guidelines. She has also led initiatives across diverse sectors, focusing on GHG emission quantification, decarbonization roadmaps, and ESG disclosures. Her expertise includes conducting materiality assessments, stakeholder engagement, and developing science-based targets to support clients in achieving net zero goals. Her work at Incorp India has contributed to enhancing ESG performance and transparency for clients across more than 20 sectors. This was a brief about Shreya Madam, and now I like to hand over it to Shreya Madam for the session. Thank you.
Ma'am, you are on mute.
Sorry, I was unable to hear in the past few seconds.
Ma'am, we would like to welcome you to start the session. Thank you.
Thank you. Let me share my screen.
Ma'am, please share the screen. We are not able. Screen is not visible.
Actually, I'm unable to share my screen. So...
Yeah, just give me a second. I'll just help.
Okay.
Tech support. Can you please make Shreya Madam co-host? Now you can share the screen, please.
Okay. I'm still unable to share my screen. I'll maybe join back.
Sure. Participants, sorry for this technical glitch. We will resume in a minute. Just give us few minutes. Yes, ma'am. Ma'am, are you able to share the screen? You are on mute. Ma'am, are you able to hear us?
I can hear you. It's
Yeah.
just that I am unable to share my screen. It's still disabled.
Ma'am, do one thing, just send that PPT to us. We'll play from
Okay.
here. Yeah.
Okay, sure. I have shared the PPT.
Okay, ma'am. Ma'am, in the meantime, you can start. We'll share.
Okay. Am I audible?
Ma'am, on which email ID you have sent? Sustainability?
Correct.
Yeah. Ma'am, please start the session. Shreya, ma'am, are we audible? Ma'am?
Am I audible now?
Yes, please, ma'am.
Hi, sorry for the glitches, last minute glitches. Um, so, my name is Shreya, and I am working as a sustainability consultant. And I have been into this field for 5 years, and I've done MBA in business sustainability as well. So, today we will be talking about carbon accounting and credits. And this session aims to unravel the complexities of the climate change landscape in terms of measurement, reporting, management, how to manage emissions, how to report emissions. So let's dive into the presentation. Uh, can you please go to the next slide? So it's a short video around climate change. We'll start with the background about what is climate change, how it is affecting organizations, affecting our planet, and other aspects. So if you could just play this video.
And we are not able to play the video.
Okay. Um, it's basically a YouTube video, if that helps. Okay. You have to press on the video, I think, to play it. Is it working? We can minimize and try maybe, or otherwise we'll move ahead.
Ma'am, we are not able to.
It's okay. I think we'll move ahead then. So So you can see like two graphs shown on the slide, and we are discussing whether climate change is real or not. So there's a debate which constantly goes on, where some people are of the view that climate change is very superficial. There's nothing called as climate change, and then there are certain theories and agreements and background research on what is climate change, how it is affecting the planet, etc. So it's important to ground ourselves in the reality backed by science. So what science says that climate change is real. So when we see weather patterns, right, the daily weather patterns, when we average them out over days, over months, over years, we see a rising trend in terms of precipitation, in terms of heat wave trends. So the trends, historical trends, have been increasing. So it's something that is backed by science. And over the past century, global temperatures have consistently risen, and it's irrefutable. So there are very strong researches around it. And alongside this, sea levels have also been climbing because of melting glaciers and thermal expansion of oceans. And these are not like some random projections, they are actually taking place. So in India alone, between Jan to September 2023, 26 of 36 states and union territories reported like more extreme weathers as compared to previous years. You can move on to the next slide. Sorry. So you can see how heat wave pattern is rising year on year, and states like Delhi, states like which are in the northern region of India, they're experiencing extreme heat waves, right? And changing weather patterns. So typically we used to say that in July, August there's a rainfall season, but now it's not happening that way. So the weather patterns have become quite erratic, and that is all because of the global warming and the climate change that is taking place. You can move on to the next slide. So cost of climate change on GDP. So, because of climate change, there has been uh, effect on the patterns, right? This is all India data, and these are all authentic resources. Uh, the impacts of climate change are basically multifaceted, and they are interconnected in some way or the other. And we are witnessing extreme heat events and erratic rainfall patterns, which affect, agricultural patterns, which affect a lot of industries, a lot of sectors in general. Because, as I earlier mentioned, right, uh, in the months where rainfall is expected, there is now heat waves. So agricultural patterns are disturbed. A lot of mining activities, a lot of other industry sectors, right? Steel, iron, every sector is impacted because of climate change and changing weather patterns. And groundwater reserves are also depleting rapidly with industrialization, with heat waves. Droughts are becoming regular, and that is also affecting the water reserves. So Himalayan glaciers are also melting at an alarming rate. These hydrological shifts are not only some environmental challenges, they are social and economic threats as well. So it is affecting organizations, it is affecting different sectors in the economy. So the economy is indirectly or directly getting affected by these climatic changing conditions. Next slide. So, commitment to the climate change, basically, there is a Paris Agreement, right? And recognizing the severity of the environmental challenges that we just talked about, India has become a signatory to the Paris Agreement in 2016. And the agreement sets a global framework for limiting global warming to below 2 degrees Celsius, ideally around 1.5 degrees Celsius, compared to pre industrial levels. So, post industrialization, the global warming has risen continuously. So now there's a cap of around 1.5 degrees Celsius of like global warming threshold, and it's as in comparison to the pre-industrial levels. So India has articulated a three clear and ambitious goals under these framework, which we will talk about later in the slide. Um, can we move on to the next slide? So basically, why are we discussing, this climate change and carbon accounting today? Because we only have one Earth, and we are not separate from the planet. So traditionally, accountants focused on financial health of companies and organizations, but today the role is evolving. The tools of accounting where we measure transparently, report, etc., it's essential for climate change. And the ways of reporting things now, it's way beyond than financial reporting and accounting. So we have to also account GHG emissions and other aspects of decarbonization when we go forward in terms of having a healthy business environment and how organizations thrive. So we have to consider the three aspects, the triple bottom line that we commonly call as it's around people, planet, and profit. So three of them have to go hand in hand. So we can't just focus on the profit part or the financials of a company. We also have to focus on the planet part and the people part. So today, when we're talking about GHG emissions, it's very crucial for the planet part because it's important that companies, manage their emissions, they report on their emissions part, and that is all financially linked as well. There are a couple of frameworks also, which we will discuss later on, which are also crucial when we talk about financial accounting and GHG emissions accounting. Next slide.
Shreya, just one question here that we have from one of the participants. Is carbon market available in India for trading? Because now we are discussing about the prima facie thing. So, is carbon market available in India for trading purposes?
So carbon market, when we talk about trading, it's pretty new right now. Earlier, it was not open. There were just discussions and some drafts around it. Recently, MOFCC has launched a draft on the carbon credits and the carbon credit market. It's a very recent draft, and there is a lot of discussions going on regarding that. It gives a whole framework. I can share the link maybe in the chat later on, the recent notification that has come up, but they are still in the draft stage, so it's open to comments as well. But yeah, it's a fairly new concept in India when we talk about carbon credits and trading.
Great, great. Thanks.
Yeah. So next slide. So what is carbon footprint that we talk about, right? It's a very basic concept, and we'll go from basic to a little more advanced approach. So carbon footprint is a measure of total GHG emissions or the greenhouse gas emissions directly or indirectly by an individual or an organization, event, or a product. So these emissions are expressed in terms of carbon dioxide equivalent. So whenever we go through some reports or whenever we talk about GHG emissions, they are mentioned. Their unit of measurement is like TCO2e, which is tons of carbon dioxide equivalent, which allows us to aggregate various greenhouse gases like methane, nitrous oxide into like a common unit. So there are multiple greenhouse gases, right? So to basically simplify and to bring one unit of measurement, TCO2 is used, and carbon dioxide remains the most dominant because of fossil fuel combustion during the manufacturing activities and during the industrial revolution, and that is why we make it carbon dioxide equivalent. Next slide. So what is carbon footprint, right? We just talked about carbon footprint, and there are multiple gases which we talked about. So this slide just kind of summarizes that as that only. Next slide. So top emitters of GHG. So globally, emissions are not evenly distributed, right? There are developing countries, there are developed countries. Industrial activities take place at different pace in different geographies. So emissions are not evenly distributed across geographies or countries or on a very micro level across organizations as well. And the top 10 greenhouse gas emitters contribute to more than 2/3 of the complete emissions worldwide. And these include countries with large industrial bases and high per capita energy consumption. So, where the industrial activity is like quite high, there the emission pattern is also seen as quite high. And India, while having lower per capita emission than some developed nations, it still ranks in absolute terms in the higher category because of its population size and the pace at which it is developing. And it underscores the need for kind of collaborations and more research in terms of and also policy formulation in terms of reducing its emissions. Next slide. So categories of emissions. So emissions are broadly classified into scope 1, scope 2, and scope 3 emissions. Scope 1 emissions are more direct emissions. Scope 2 emissions deal with electricity, purchase of electricity, grid electricity, purchase of renewables. And scope 3 are the indirect emissions. So scope 3 further has like 15 further categories which are applicable to different organizations as per their nature of business, operations, geographical boundary, products and services that they offer, etc. So a lot of factors contribute to that. And a comprehensive carbon footprint would include all of these three scopes or categories. And usually scope 3, like GHG accounting, is a more complex and more advanced level of accounting, because it deals with supply chain partners, it deals with value chain partners as well, which is more indirect. So it's sometimes difficult to get data around it. It's sometimes difficult to, accumulate information pertaining to different categories in scope 3. But companies have evolved over a time, and there are organizations which are mature enough, which are calculating their GHG emissions under the scope 3 category as well. Moving on to the next slide. So this briefly sums up the entire value chain, and every part of the value chain when we talk about business setup. So if there's an FMCG company, for example, so every value chain phase would have some sort of an emission. There would be some packaging involved, there would be some product manufacturing involved, there would be some raw material procurement involved, some logistics involved. So every phase would have some sort of an emission involved. So from getting the raw materials till delivering the product till the end phase, every phase will have some sort of emissions linked to it. And emissions can overlap, or it can spread out across different organizations as well. So we procure, say, raw material from organization A, then packaging from organization B, then we sell it to some organization C. So there are different organizations which are also involved in the process. And understanding where and how emissions are generated basically allows companies to target the most carbon intensive part of their operation. So why we basically account for emissions and measure them is because companies have to eventually lower their emissions, and there are certain emission reduction targets at national level and at global level and at policy level as well. So companies have to work towards it. Next slide. So these are, it's like a small exercise, fact check, which emissions, which scope would these fall under? So boiler consuming coal. We can move on to the next slide. It has, it has some, yeah. So boiler consuming coal, right? It will come under scope 3 because it's direct. The boiler is basically owned by the company. So any manufacturing company that we talk about, there would be some boilers which would be used in producing products and services. So it would come under scope 1, which is direct emissions. Then electricity purchased from grid, scope 2, because scope 2 consists of electricity from grid and purchased renewable energy. And then electricity generated using own DG set. It would come under scope 1 because it is directly being produced by the organization. Fuel reimbursement paid to employee. So any fuel related expense, either it is used in the company owned vehicles, or it is reimbursed to the employee, but the vehicle is owned by the company, then it would fall under scope 1 because it's like a direct emission. So how it is also linked to financial accounting as well is that we usually see the ledgers or the annual report or some financial background of the company, because it's sometimes difficult for us to consider which scope this would be accounted for. So we have to see the ownership of the vehicle. We also see key, for example, it is saying fuel reimbursement paid to the employee. So in the ledgers, is the reimbursement part mentioned or not? Or is the employee paying for it? So if the employee is paying for the fuel, then it will not account for scope 1 emissions, even if the vehicle is owned by the company. So it is also linked somewhere with the financial accounting part. And then flight booking for employees, it's an indirect emission because it's like a third party thing, right? The flight that the employees take, or it is the flight bookings that are done for business travel. It's a very indirect emission because flight, fuel, etc. is everything is paid by the airlines, right? So it falls under scope 3 emission. Then renting of shuttle buses for employee office travel again is a scope 3 emission because it's a rented service. The fuel or the vehicle again is not directly, it falls under the scope of the company. Then LPG used in office canteen, scope 1, because all the fuels that are essentially used by the company, that the company pays for it, it falls under scope 1 emission. Cooling gas filled in air conditioners. So there is a category of emission that is called as fugitive emissions, that essentially considers any gas leakage, cooling gas filled in air conditioners, fire extinguisher related gas that gets filled in probably every year or twice a year. So all of that is considered under fugitive emissions. So it is also part of scope 1 emissions. Then steam purchase from third party. Again, any steam, any coal, any heat which is purchased from third party, it's very prominent. Steam purchase from third party is very prominent in chemical industries. So they purchase steam to manufacture their product, to carry on the chemical manufacturing process. So all of that, anything purchased in terms of steam, coal, heat, it also falls under scope 2 emissions. Then freight paid for raw material, scope 3, because it's indirect. Raw material basically would bear some kind of a logistic cost, so it's indirect, so it would fall under scope 3. Then hotel booking for employees, so hotel travel, everything which is kind of indirect, because hotel is again a third party thing, so it would fall under the scope 3 emissions. Electricity generated by coal in coal power plant, so coal power plant ke liye direct emission hoga electricity generation by coal, so that is how it will fall under scope 1 emission. But for a non-coal power plant, some other organization, electricity generated by coal, it would probably fall under um, scope 2 emissions. Moving on to the next. Next. So GHG protocol. So when we talk about calculation of emissions or certain guidelines of emissions, emission accounting, so there is a framework around it which guides how emissions should be calculated, how emissions should be considered, what boundary setting should be there. Should there be some kind of a base year? Should there some kind of a target setting? So there are holistic guidelines around it. And the greenhouse gas protocol, or the GHG protocol, is the Bible for that. And it's the most widely accepted and practiced framework. And it's developed by World Resources Institute and World Business Council for Sustainable Development. And it offers standardized methodologies to measure and manage GHG emissions. And it's very common to say that 9 out of 10 companies would be reporting emissions, globally as per the GHG protocol. So it's more of a global framework. So any company across the globe can use this framework to calculate, manage, monitor its emissions. And it ensures comparability, credibility, and consistency in basically how the emissions are recorded and disclosed. So we can do peer analysis. If some peers have done for a particular industry, they have used GHG protocol to calculate their emissions, we can basically compare it from peer to peer. And businesses which are aiming to align with international expectation, such as going ahead with ESG ratings for CDP, for DJSI, for EcoVadis, any investor-driven, requirements around emissions, or something for regulatory compliance. So, for example, the BRSR by SEBI, it mandates that the companies have to disclose around emissions. Scope 3 is under leadership indicator currently, but scope 1 and 2 emission, the companies have to report. Energy related indicators, the company has to report. So to calculate those metrics, GHG protocol is the framework. It's the go-to standard for, I think, almost all the companies. Next. So these are some of the principles of GHG accounting. I think we have discussed around this, that how the data will be useful in decision making when it comes to relevance, completeness, completeness, I think, is one of the most important principles, because most of the time, the companies or the organizations don't really, there is a chance of basically missing out on some information. So when we talk about, especially on the scope 3 emissions, right? So the company might not be aware that in, for example, capital goods, what categories should be taken care of. Uh, in business travel, what kind of data should be there. So in terms of completeness, the data should be complete when we are talking about calculating emissions as per the GHG protocol. Then consistency should be there. So year on year, there should be consistency in terms of using the methodologies. So for calculation also, there are 2, 3 different methodologies as per the company, as per the boundary setting, etc. And accuracy should be there, so errors should be minimized in terms of calculation. So we also deal with emission factors, so there should be consistency in using the emission factors as well, in terms of using the guidelines. Then transparency would require organization to clearly document their assumptions, sources and methods. So organizations work in a very complex manner, right? For a FMCG company, there might be different sub-segments. There would be a processed food segment, there would be a personal healthcare segment, there would be a cosmetics segment, then home care segment. So it's a very vast kind of a business, right? And companies, mostly have complex supply chains, complex way of working. Um, they might be having some subsidiaries, they might be procuring raw material from different sources. There would be, the supply chain would be quite complex and quite huge. So to calculate emissions, to gather data, to consolidate data from each and every supplier, from each and every source, from each and every factory, industry, manufacturing plant, etc., it can be a little overwhelming. So transparency would imply that if some company is taking some assumption, so for example, a very basic assumption would be that some of the plant would have shut down right in the middle of the year. So the emissions would, decline as compared to a previous year. So, the company has to mention very transparently that this is the reason that it is declining. So these principles, they don't only ensure that the data, the emissions that are calculated are credible, but it also enables verification methods. When companies go for third party assurances, if consistent data is being used, if proper assumptions are being laid out, it enhances the credibility for the assurance process. Next slide. So this is a typical process of how emissions should be calculated. There's a boundary setting, so there should be it would be as per organizational boundary or operational boundary. Um, and then organizational boundaries basically determine whether a company reports on just its standalone operations or also includes its subsidiaries, which is commonly called as a consolidated approach. And there's a equity share approach where emissions are reported in proportion to the ownership and control approach. So I think we'll discuss it in the next slide. Then there is selection of approach of calculation, then determination of emission factors. So there are 2, 3 sources where the companies can go for finding the emission factors. So what emission factor essentially mean is that if we have to calculate how much emissions are we get from basically consumption of some kind of a fuel, say coal. So there are some emission factors which we multiply and then we get the emissions equivalent to it. We will discuss in the further slides how it is done exactly. And then collection of data, and then it gets consolidated at the organizational level, either in a standalone or a consolidated approach. Next slide. So this is the equity share approach that I was talking about earlier, where emissions are reported in proportion to the ownership. And control approach implies that 100% from the 100% of the emissions from entities for which the company has financial or operational control. So financially, we see that how much control the company has, and then the control approach is basically used. For example, if a company has controlling stake in a subsidiary, it must account for all emissions from that subsidiary. So it would help in identifying the real influence on emissions, across its like corporate structure. So that is how these two approaches work. So most of the companies go for operational control because it's easier to identify the activities and emissions across the value chain. But financial control is also a way to go about calculating emissions. Next slide. So this is a definition of organizational boundaries. I think most of you would be aware about the terminologies of what group companies, subsidiaries, associated, affiliated companies are, joint ventures are. So a short description around that. So this distinction is crucial because operations of different companies are complex. For instance, like a power plant, which is owned by a third party, it might contribute to scope 2 emissions of the company. But scope 1, uh, so sorry. But scope 1 would be like the generator, the electricity generated from the generator. So it's essential to ensure consistency in the scope, year on year, and entities which get included year on year in terms of calculating emissions to basically maintain consistency. Next slide. I think these are just some examples. Next slide. So this is like a classic example, right? Electricity, most of the companies face issues. It causes confusion in carbon accounting as well. So suppose a company, has like a generator A. So for its generator A, though A scope 1 emissions would be 20 ton, and then it gives on to B, then it becomes scope 2, and then for end user and the utility company, it becomes scope 2 and scope 3 emissions, right? So there the double counting is basically avoided. So emission factor is also considered. Every country, every geography would have a different emission factor. So the electricity organization, CEA in case of India, it determines the emission factor or intensity in India. So in different geographies, there are different agencies which would publish the emission factor for electricity in different, so that particular emission factor is considered while calculating emissions. Next slide. So double accounting is one of the major challenges which companies face. Um, it occurs when more than one organization claims the same emission reduction or generation source, right? So the JG protocol addresses this by clearly defining what can be claimed under scope 1 emissions and what can be claimed under scope 2 emissions. So for example, if a company generates electricity, it would fall under their scope 1 emissions, and another company which consumes it, it would fall under the scope 2 emissions. So when we talk about grid electricity, usually the government agency who would be producing or responsible for producing the electricity through grid, for them it would be scope 1 because it's a direct emission for them. But for other organizations, for manufacturing companies, for other companies or even households who consume the grid electricity, it would be scope 2. It's indirect because they're not directly producing it, right, in their facility. So um, we cannot consider it under scope 2 emission for organization. So this is a very common misconception. Similarly, for energy consumption through a diesel generator, right? So a company would typically purchase diesel, and then it would use that diesel in producing electricity from DG set, right? So there might be double counting because it would consider fuel in the fuel component in scope 1 and then generation of electricity in scope 2. So to avoid that, we consider the DG set generated electricity, because there the actually the fuel is getting converted into energy. So that is how double counting is avoided. Next slide. Identifying GHG emissions. So there are different types of categorizations. So there are sources, right? When we talk about GHG emissions, how do we identify them? There are different sources as per the GHG protocol. Stationary combustion is one, where it involves equipment like boilers, furnaces. So any fuel that is consumed, company owned vehicles. Mobile combustion covers transport vehicles. So the company owned vehicle, the fuel consumed there, it would fall under mobile combustion. Then process emissions result from chemical reactions like CO2, which gets released, for example, during cement manufacturing process. Then fugitive emissions, which we talked about earlier, the unintended leakages from equipments, or the fire extinguisher, the refilling of fire extinguishers, AC units, the gas that gets refilled in the AC units, that gets considered under fugitive emission. So all of that is a part of that. um, and then for office-based businesses, direct emissions might be minimal, unless they operate on vehicles or use like heavy refrigeration related systems. So even service organization contribute to indirect emissions, and electricity usage, business travel, and purchased goods and services. So even service industry has some sort of emissions pertaining to it. It's not just the product based companies or organizations. So even a financial services provider, even a insurance company would have certain emissions with respect to maintaining and running a corporate office, in terms of business travel, in terms of owned vehicles. So almost all businesses would emit some kind of or the other kind of emissions, either directly or indirectly, right? Electricity usage is one common, which I think almost every industry would be utilizing. So this is how we identify GHG emissions on a very broad level. Next slide. So how do we essentially calculate the emissions that we have been talking about since the past 40 minutes? So there is a method, right? Now the sources are identified. So we know what scope 1 consists of, we know what scope 2 consists of. Now we have to calculate. So there are two approaches. One is like a direct measurement, which is highly accurate but resource intensive. And second is using of emission factors. So we'll talk about that in the next slide, but this slide essentially sums up that there is some kind of an activity data that we have, and we multiply it with some kind of an emission factor, and we get the GHG emissions, right, which is TCO2e equivalent. Next slide. So there are emission factors, right? And different fuel would have different emission factors, different kind of activities. So fugitive ke liye there will be different kind of emission factors. Electricity generation would have different emission factors. And there are broadly, globally, three sources from where we get emission factors. One is US EPA for companies who majorly operate out of the US. Because it's a developed country, their emission factors are on a little higher side, right? Then we have DEFRA, which is basically EU based. And in India, we use IPCC emission factors. So IPCC emission factors are basically a little, they're old. Last, I think they were released in 2006. But uh, there, since the businesses are evolving, there are some emission factors which we would not find in IPCC. So we can use a mix of IPCC and DEFRA. DEFRA is the next nearest emission factor guide that we refer to when we calculate emissions in the Indian context. Because US is a fairly developed country, their emission factors are on a higher side. So DEFRA and IPCC are the two go-to emission factor guides. It's very commonly available across Google. Uh, Links are also available in the slide. So, and CEA gives you the emission factor for grid electricity in India. So it's a standard emission factor. So that is how it is determined. The activity data that the company has, for example, it has, we accumulated that the company consumed, say, hypothetically 6,000 liters of diesel, right, in an year. So 6,000 liters multiplied by the emission factor of diesel, which is given in IPCC, would give me the emission, that is emission in terms of tons CO2e, that the company would have emitted during one financial year in terms of diesel consumption. So ideally, that is how we come up to the emission calculation. Next slide. So collection of data. Basically, carbon accounting is only possible when we have sufficient data, when we have complete data. And there, like, organizations should establish like clear systems for calculating energy related data, procurement related data, facility level data. So there are a lot of tools in market nowadays. There are softwares um, which help companies, manage their energy related data, fuel related data, other emissions related indicator wise data. So the final report should present emission broken down by scope, sources, and explain any exclusions as well. So there might be a case where fuel related data might not, the company might not have clear visibility because there are a lot of company owned vehicles, and the traceability is currently not there in terms of how many times the fuel has been refilled in a year. So the company can clearly mention that this year, we're not tracking the company owned vehicle related emissions. But next year going forward, we will maintain a complete repository of data, and we will report the emissions accordingly. So any exclusions that the companies might, go forward with, any assumptions that the companies might take, that needs to be clearly laid down, right? For scope one, it's a kind, we have to like consider, there are logbooks, there are companies have different softwares to capture data. So those are the go-to places for collecting data. For scope 2, majorly electricity bills are collected, or any PPAs for renewables that the company has, that we see for collecting the activity data, and then it is again multiplied with the emission factor. And for scope 3, it is either the dumps, the raw data dumps, or the values which are reported in the annual report in terms of purchase goods and services, capital data, capital goods data. For business travel, usually the HR would have clear visibility on the business travel. For employee commuting is also one category in scope 3 emissions. So that waste management, the operations or environment team might have much better visibility on how the waste is getting traced, in terms of hazardous, non-hazardous. So different sources are there, different softwares are there where we can, collect data, and then we can make the final emissions report. Next slide. So this is like the final emissions report. So it would have a typical breakdown as to, like, it really depends on sector to sector, company to company, how emissions are represented. How it's better if we break it down as per scope 1 emissions, scope 2 emissions, scope 3 emissions. Region wise we can break it down. Manufacturing facility we can break it down. Furnace wise we can break it down. So majorly I've seen some of the glass manufacturing company reports which break down emissions as per furnace, because it's a very emission intensive industry where a lot of fuel is consumed. Furnace plays a key role. So furnace size emissions are also there. So mostly it's a investor driven request again, but you can break down emissions into different categories, into different manufacturing facilities, etc. And you can also show a year on year trend to track progress around the reduction targets, to develop newer initiatives. Um, and all estimates, all assumptions, all exclusions, it should be transparently provided in the final emissions report for a clear understanding. Because if I have to compare it year on year, or say peer to peer, then I should know that what are my exclusions, what are the assumptions that I'm taking, that would help me in better comparison with the other peers. So it would also help in third party verification when we go for non-financial assurances for GHG emission, GHG accounting. It also becomes easier, right? If everything is transparently put into the final emissions report. So then this particular report, which has like a breakdown of everything, every kind of emission, then we can put it in the TCFD disclosures, we can put it in the sustainability reports, we can put it in the annual report, we can set targets, we can ensure credibility of our data. So this is how final emission report is basically prepared. Next slide. So it's a very generic example that I was talking about. Diesel consumption, the activity data we have. Then we have the global warming potential. We have emissions in TCO2e. So different gases we account for. So this is as per GHG protocol, right? Emission factor is there for the different gases we calculate, and then we add up. So for CO2, CH4 and N2O, then we calculate emissions TCO2e, and then we add it up, and it comes up as our total emissions for diesel. So it depends on how much fuel combustion is taken place. So in one financial year, if fuel is procured, say 1,000 liters, and fuel combustion is 264.17, we consider the fuel combusted value and not the total fuel procured, because emissions would practically be there if the fuel combustion takes place. So on the fuel combustion part, we calculate the emissions, and then it totals up to 2.76 tons carbon dioxide equivalent. And this is how it is done for different fuels. It is done for the fugitive emissions, for the mobile combustion, similarly for electricity and scope 3. So the method remains the same.
So Shreya, just one or two maybe questions here that we received from the participants. So,
Hmm.
you showed us various calculations, and there are a couple of other calculation methods that you showed. Okay.
Hmm.
Is there any specific calculation method that India follows? Maybe, if there is any kind of guidance from BRSR or GRI, and maybe if there are any kind of disclosures or some specific guidance given by SEBI as well.
So wherever you'll read, you will get a cross reference of GHG protocol. Even SEBI would recommend that you use GHG protocol. So GHG protocol basically, since it's a global framework, right? So companies have to choose how the boundary setting will be done. How different, in terms of scope 3, there are different types of like methods to calculate scope 3. So there's one spend-based method wherein you see how much the money is spent on purchased goods and services, for example, and then you multiply it with the respective emission factors. So there's a spend-based method. Then there's like activity data. Then there is this activity data we have discussed in length. Then there is this average method where we average out certain values because the data might not be available so different companies have different contexts depending upon the data availability, depending upon the activity data, depending upon the financial data, depending upon how they are maintaining it. Different methodologies are there which are recommended as per the GHG protocol.
Mhm.
So you just have to mention in the report that we have followed this method, and it's more or less consistent for scope 1 and 2. It's a very basic method, just that scope 3 is a quite complex, because it has different categories, then different categories have methods. So there's no standard method per se, but then it depends on what kind of operations the companies have, right? So for example, there is a category of waste in scope 3. Um, a product based company would have very, extensive categories of waste in terms of hazardous, non-hazardous, whereas a service industry would barely be having like paper waste or plastic waste, office based waste, right? So the method would differ accordingly. The type of calculations will differ accordingly. So
So,
GHG protocol, the guidelines that GHG protocol gives, SEBI also cross-references that, GRI also cross-references that, TCFD also cross. So every framework, wherever you'll go, in terms of calculating GHG emissions, GHG protocol is the most widely used framework.
okay, so just to conclude, or maybe to summarize, when I have or when I look at the regulatory landscape in India, evolving around the sustainability and carbon disclosures,
Hmm.
would it be fair to say that it's revolving around the GHG disclosures, or the GHG protocols itself?
So sustainability is a very wide domain, right?
Mhm.
So GHG emission or emission accounting is just one part of it, right?
Understood.
So I'll break it down for you. When we talk about sustainability, we talk about three basic pillars: ESG, environment, social governance. Under the environment bucket, there are certain categorization. Broad categorizations would be 4 to 5. One would be emission management, waste management, water management, and biodiversity. More or less, these are the 5 categorizations you'll see everywhere in BRSR, in GRI, in any other TCFD framework. Anyway, revolves around certain different recommendations. But reporting wise, these are the 5 categories under environment. So emissions management, when we talk about, then we refer to GHG protocol as a framework for calculating emission, for managing and monitoring emissions. So that is how it works.
Thanks for that clarification. So maybe we can take up few questions after a couple of slides.
Okay, sure. Next slide. So these are some of the intensity metrics, right? So why do we need to calculate intensity? To just see that in terms of products, right? If there's a can of cola, so if I'm a company who's manufacturing a can of cola, how much emissions am I emitting by manufacturing one can of cola, right? So kg CO2e per 330 ml can, which is like a standard size of a can, standard volume of a can. So intensity metrics are calculated to see how much emissions are calculated per, some metric, per rupee, per revenue metric, right? There are different metrics in the BRSR as well. So in terms of washing machine, it could be per wash. In terms of television, it could be per hour of viewing, or so some metric. When we divide it by total emissions, then we get the intensity, how intensive it is, how the emissions that we are calculating per product, per unit, per metric, per any indicator, how much emissions are getting emitted. So they are then compared with industry best standards, right, across peers. And then we see, so there's no good intensity metric or a bad intensity metric. It could be higher or lower as compared to maybe peers, higher or lower as compared to some range that some rating agencies would have recommended. So it's viewed from that lens. So it's like the financial ratios that we calculate, right? It can be higher or lower, when we say PE ratio. So we see it from the lens that X company has a higher PE ratio, whereas Y company has a lower PE ratio. Uh, there's not like one is a very ideal PE ratio kind of a thing. It's very superficial. So intensity also works like that. So it's basically a ratio viewed with the lens of comparison with some other metric. Next slide. So this is how BRSR recommends it. So there is like total scope 1 emissions when the company calculates, then scope 2 emissions, then combined scope 1 and 2 emissions, and then it calculates total scope 1 and 2 emission per rupee of turnover. So we have to see what is um, per rupee of turnover. We divide it by the total scope 1 and 2 combined emissions, and we get some value, right? Then in terms of purchasing power parity, it would be the revenue adjusted for purchasing power parity as per the IMF data for PPP, which we would get like easily on Google. So it would give you a like PPP in terms of dollar. We consider it usually the value which is there as at 31st March of every financial year, because BRSR is prepared as per the financial year. So we divide it by the total emissions and we get the intensity as for adjusted PPP. And then scope 1 and 2 emission in terms of physical output, again, in terms of product based companies, physical output is divided in terms of tons, and we get the intensity for that. Uh, Again, for comparison, it is good to mention any exclusions or assumptions. And then there are some voluntary intensities that the companies can calculate in terms of units of product. So if I have produced like 1,000 units of product in one financial year, I can divide it by my scope 1 and 2 combined emission, and I can get the intensity. Then production volume, size in terms of floor space, or number of full-time employees. So these are very rare, people calculating intensity in terms of number of full-time employees or something. Usually intensities are calculated per rupee of turnover or PPP or physical output. Similarly, it goes for GRI as well. GRI, when we draft sustainability reports, it also asks for emission intensities per rupee of turnover or for revenue, total revenue. So we divide it by total revenue and we get like some intensity figure for that. So it basically signifies that per rupee of my revenue, what emission intensity is there? What is the emission that I've emitted per rupee of my revenue? So that is how the interpretation works. Next slide. So these are some of the examples. The AXA sustainability report example, where this is how usually it is calculated when we talk about environmental indicators. So number of group full-time employees, and then internal area occupied. Then they have KPI on the emission intensities, how emissions are basically displayed in reports. They are reported, they're disclosed in reports. So yeah.
So Shreya, since we are now into the number game, and this is where we as chartered accountants love the numbers, So, as an initial ask, how do you think that carbon accounting can integrate with the financial accounting element?
Okay. So I think when we talk about emission reduction also, it definitely has impact on the revenue part. It would most of the numbers flow down from the financial part. So if I see, for example, when we talk about say scope 3 emissions, when we talk about capital and purchase goods, right, there would be some number equivalent to purchase goods, right? There is a concept of locally sourced goods and services. They would have a comparatively lower footprint, right? So geography wise also we see, so locally produced goods and services would have like a lower footprint, whereas something which is imported would have a higher footprint. So it's all calculated based on the accounting numbers. When we talk about electricity, right, I was recently working for some client where we actually were able to figure out, we have to basically find the activity data, right, that how much consumption is done. But when we see the ledgers, when we see the accounting information, we get to know that certain electricity bills were reimbursed, right? So even the companies don't have much visibility on that. So it is completely linked with the accounting or the financial information that the company has, in terms of capex, in terms of other categories. Financial related information plays an important role. So most of the companies are also investing, right? They are investing into decarbonization, they are investing into other technologies, AI related aspects, softwares to streamline the process in terms of numbers. So it is all interlinked.
Understood. And so, say for example, so suppose a company, so there is a holding company and then there is a subsidiary company, okay, and the subsidiary company discloses on an operational emission basis, okay. So, is it such that the parent company also has to disclose it in the similar fashion, or the parent company can follow a different method of disclosure?
Ideally they should follow the same method. The boundary setting is very crucial, right? So if the parent company thinks that it will go for a standalone accounting process, then whatever boundary it is decided, and if the subsidiary company also wants to go for it separately, then similar boundaries should be considered, because that would ensure comparability. Or otherwise it is recommended that they go for a consolidated approach, because again it depends on the financial part as well, right?
Understood.
So we determine the operational control based on how finances are accounted for the subsidiary. So if there is if similar approach, similar boundary setting is there, comparability would be easier. So
Mhm. Understood. Understood. Maybe we can continue with the next slides.
sure. Next slide. So this is also another example of how a GHG report would look like. This is a very detailed GHG report where they've given a detailed breakup of different gases, right? And then they have cumulative scope 1 and scope 2 emissions. So how much emissions are there in terms of different gases? So when we talk about the cumulative scope 1 emission or scope 2 emission, they are carbon dioxide equivalent. You have any questions?
Mahesh, if you have any questions, you can put it in the chat window. We can take it up subsequently. Thank you.
So when we talk about like scope 1 and scope 2 consolidated emission, they are all converted into carbon dioxide equivalent, right? But BRSR also asks for different, breakup of gases. So this is a very good example of they've shown like CO2, then methane, then nitrous oxide. So different kind of GHG, gases that are there, and what are the global warming potentials. So global warming potential is used to convert it into carbon dioxide equivalent, right? So when we say methane has a GWP of 25, that means that we it's like the total emissions when we talk about, so 25 times equivalent of CO2. That is the way we basically read it. So this is the breakdown of different GHG gases, and then they have shown the cumulative direct and indirect emissions. We can go on to the next slide. So can we play this video? Can we try with this video? We can't hear, I think. Can you unmute maybe?
The voice feature is not there. We can just play the video.
Okay, let's leave it then. So I think let's leave playing the video then in that case. So once we calculate the emissions, right, the next step is decarbonization. So what essentially we mean by decarbonization? It basically refers to the reduction of GHG emissions through combination of like operational changes, technology upgrades, process redesign, right? It can involve a lot of R&D. So we keep hearing the words that like in terms of especially plywood industry, they have come up with this new offering of MDF, medium density fiber board, which they claim is it emits lesser as compared to a standard plywood board. So the manufacturing process is very different to produce a MDF board. So that is how process redesign can help reduce emissions. So basically, if I walk through briefly, when we talk about plywood manufacturing, it involves a lot of chemicals, a lot of machinery which is involved, a lot of energy which is involved. Uh, Very high quality of wood is required to manufacture plywood. So when then the companies nowadays are manufacturing MDF boards, it's nothing but the the lesser good quality wood is basically shredded, and then it is compressed through different forms of compressions, water, chemicals, and then it is given a very smooth finish, and that is how MDF is manufactured. So the waste that is getting created in the plywood manufacturing process, it is reutilized in the process. So MDF becomes technically a less emission intensive product. So that is how technology, that is how process redesign would work. So it also includes like increasing carbon absorption via nature-based solutions. So when we talk about reforestation, also decarbonization, the carbon intensive activities, we can offset that.
So Shreya, a simple or maybe a little bit of a basic question here. When we talk about decarbonization, and there are various other terms as well that we hear, that say it is carbon neutral, or it's net zero. So in context of decarbonization strategies, what is a basic distinction between carbon neutral and net zero?
Okay, I'm coming back to the next slide.
Okay.
So you can change the slide. So this is like a visual depiction of what carbon neutral versus what net zero is. And these two terms are mostly used interchangeably, but they are like really different when we talk about conceptually. And carbon neutrality basically means that the company balances out its emissions by purchasing, uh, different amounts of offset. So either equal amount of offset. So if my total emissions are 1,000 TCO2e, then I can buy offset equivalent to 1,000 TCO2e, or maybe more than that. So 1,500 TCO2e is also something that I can buy in terms of carbon credits, and I can offset that. So investing in renewable energy, afforestation, etc., would also be a part of it. And this does not necessarily mean that the company has reduced its own emissions. It is just offsetting what it has, produced in terms of emissions. And net zero is it's like a target or a goal or ambition that the companies take, that I want to be net zero, right? And it implies that no carbon was emitted at all, or the emission basically was neutralized, right? So it's a systematic transformation of how the company is operating, um, in terms of energy usage, in terms of um, so net zero is basically, when we talk about SBTi, right? It's like a board which approves net zero targets. So their offsetting is not allowed. So you have to be net zero in terms of not producing emissions at all. So you have to, maybe one way is like afforestation. So the emissions that you are producing, you're also you're taking afforestation activities, and you're sustainably cutting down on your own emissions, right? Buying credits is not the way to go for net zero. So if you're going for SBTi targets, if you're saying that I'll be net zero by 2050, that means you're not buying credits to offset your existing emissions, but you're reducing your emissions, right? It's very difficult that way, because even if you buy the best of technology, even if you reduce your emissions by integrating different newer processes, changing in product design, changing in R&D, you'll obviously consume some part of you'll obviously consume electricity, right? Scope 2 emission will be there. Renewables, no matter how much you invest, you'll be using electricity, grid electricity. So it becomes a little difficult for companies to basically go for it. But net zero commitments are there, then net zero targets are there. So commitment is something which SBTi approved. It's not that, it's not SBTi approved. Targets are SBTi approved. So it's like a very generic difference that is there. I hope I've answered your question.
Yes, pretty much clear.
Yeah. Next slide. So this is like net zero roadmap, right? India's net zero roadmap is also there. We have a detailed slide on that also. So India in COP26, we have these 5 targets that Mr. Modi has basically talked about. So around fossil fuel energy, around energy requirements, around carbon intensity. Then most of the countries are claiming that they'll become net zero by 2030, 2050. India has targeted 2070. So when we say that a country has claimed or maybe set a target of net zero by 2070, that means the organizations cumulatively, they are becoming net zero by you know by a deadline which is lesser than 2070, and that is how the entire country becomes net zero. So this is how, on the left side, if we see, this is a organization level net zero roadmap. So it can be year on year. So if I say that I have a net zero ambition of 2040, so I'll have to set a baseline, right? My emissions will be net zero from what year? From maybe 2010, from 2020. So there's a baseline setting. From that baseline, I have to see uh, till my target year, how much emissions can I reduce? How can I become net zero? What kind of actions, what kind of interventions, what kind of process changes, what kind of goals I have to take in order to become net zero, right? So this is how companies show their roadmap. It's just one example. Many FMCG companies have targets of net zero, many cement companies, many steel related oil and gas companies, they have targets of net zero. So there's an action plan basically attached to it as to how they will achieve this ambition. And the progress is constantly monitored by SBTi. So that is how this entire roadmap works.
So Shreya, nowadays people keep on using these biofuels and bio-blended fuels and all. So does this help to reduce the GHG to a certain extent? And if yes, then how is the calculation being made? Considering the normal diesel versus say the biodiesel or the blended diesel. So how is it being calculated?
Hmm. So again, it will, there are like 2 ways to go about it. First is a very basic explanation that I would give, is that yes, biofuels do help in emission reduction. And for example, companies or industries which are highly dependent on fuel, which are highly dependent on furnace based manufacturing activities, for them biofuel is like very important, right? Their emission is significantly lower. Their emission factors, so calculating emission will remain the same, right? no matter you use fuel, normal fuel, conventional fuels, or you use biofuels, there are different emission factors attached to it, right? So you will get emission factors for biofuel and DEFRA, which are significantly lower, and it helps in reduction of emissions as well. Also, the second part to it is that every industry would require different kind of a biofuel, right? uh, so I was recently working with a marine sector company, a ship management company, and there what I understood, what based on the conversation I had with the client, was that shipping requires certain type of a fuel, right? um, and biofuel is also one part which the shipping industry in general is exploring right now. But because shipping industry is something which is global in nature, because it operates from different, operates from port to port, then the uh, location varies, the regulation varies. There are some stricter, in the EU side, there are some stricter penalties. So I think in France, or I can't recall one geography that we were talking about, biofuel has become like mandatory there. So you have to use biofuel in ships. So the challenges are there. It's very difficult to procure biofuel in the shipping industry, right? So it's not just like there is a replacement, go use it, reduce your emission. Procurement remains a challenge. In terms of intensity, it is not that great in the shipping industry. In terms of you know per nautical mile traveled, right? A biofuel will not give you a very good output as compared to a conventional fuel. So there, it's like full of challenges when we talk about the shipping industry. But otherwise, if we talk about some other industry, say a plywood industry, say a cement industry, um, these fuels in terms of bio briquettes that we call, biodiesel that we call, the greener fuel options that we commonly refer as, these are available as well. They don't have these complex challenges as which are present in the shipping industry. But then again, they also come with their set of challenges, right? So when we talk about biofuels with different clients, with different setups, with different geographies, different manufacturing facilities, it's not that smooth. So companies can use it. It will give them a benefit in terms of emission reduction. But currently, no company is completely relying on biofuels for their operations. So a lot of, we have a lot of R&D to do, a lot of challenges need to be addressed when we can say that yes, companies are completely relying on biofuels. So that journey is like very long right now. But yes, emission wise, it gives you a great reduction because it's very low, like it's 0 point something, it's even less than 1 when we talk about the emission factor. So when we multiply it with the consumption, it's like very low in terms of when we consume the conventional fuels. So yes.
Understood.
So optimize, replace, and offset. It's a practical approach to emission reduction. Optimize energy and process efficiently, reducing waste, efficiently using, optimizing resource efficiency, etc. It would help in emission reduction. Then replacing fossil fuel based with renewables. So the transition and shifting to renewables, that would also help in emission reduction. And offsetting residual emissions, which are basically difficult to eliminate, right, in short term, using carbon credits, and it would help in overall emission reduction for the company. So improving efficiency, emission reduction, and offsetting are the three thumb rule, aspects that the companies can consider while taking net zero emission or becoming carbon neutral. So overall decarbonization approach that we talk about. Next slide. So India's decarbonization target, again, we talked about it already, but these are the targets that are at the country level, and carbon footprint intensity reduction by at least 45% by 2030 as compared to 2005 levels. So here 2005 is the baseline and 2030 is the target year. So that is how we read. So uh, 45% at least reduction, so 45% or higher reduction as compared to 2005 carbon intensity levels. That is one target. Then non-fossil fuel capacity to achieve 500 gigawatt of non-fossil fuel-based power generation capacity by 2030, um, meeting 50% of its energy needs from renewable sources by 2030. And reducing, so this we have discussed, and then India seeks to reduce its projected total carbon emission by 1 billion tons by 2030 and net zero by 2070. So these are the targets, right? But a lot needs to be done to achieve those targets. So different sectors have to work in a way that uh, net zero targets get achieved. um, Renewable sources, so building of infrastructure for renewable sources of energy, solar, wind, all of that. Infrastructure needs upgradation. Green hydrogen is something which is most talked about right now in terms of um, the fuel that we are talking about, right? So a lot is going on in the background to achieve these targets, sector wise as well, on a country level as well, on policy levels as well. So these are some of the decarbonization targets that India has.
So, Shreya, if at all, if there is any company, who hasn't started off with its net zero or, approach towards decarbonization, wants to start off with decarbonization stuff and right from the scratch, then what or how can you give them any kind of a guidance about how they should start off with any initial pointers?
First, I would say analyze, right? See what guidelines are there for your particular sector. See what your peers are doing in terms of emissions, how they're reporting it, how they're measuring it. See what ESG ratings are, required. They have certain guidelines around emission reporting, around targets, around progress. Analyze the landscape first with respect to your particular sector. And then step two would be analyze your own company. So see how well you can collect data, how well you're measuring data. So one client I was working with, in terms, so obviously for decarbonization is like one of the last leg in emission management. You have to start with calculating emissions first to see where you stand, right? So for calculating emission, you need activity data. For activity data, you need to collect your data, right? For one company I was working, they said that we don't have electricity bills. We just pay it off. We get a message that this much needs to be paid off. We don't have hard copies of our electricity bills. Some companies have leased offices. For example, uh, in Gurugram, DLF is the building owner, and then there are leased offices in one building. They might not necessarily be getting some kind of bills, right? So data collection, how are you? So you have to internally analyze that what is the data that is required for calculating emissions. Do we have the data? Do we have enough bifurcation? Do we have enough measuring tools? For waste is also scope 3, right? For waste data, do I have categorization or not? So companies which are working under lease model, most of the clients that I come across, they are like, we just hand it over to the building owner. We don't know where that waste goes after that. So we can't find data around recycling, around reuse, around incineration, around. So what happens with the waste, right? How is the company managing its waste? So in terms of electricity, in terms of renewables, right? In terms of water consumption. So internally analyze, do you have enough data around emissions activity data? Find a tool, start preparing, start collating data, start analyzing your data, and then uh, you have to multiply it with emission factors. See, that is calculation of emissions is fairly sorted then, because you have the activity data with you, you have emission factors which are easily available on Google. So your emissions will be calculated, but you have to see the major chunk of time goes in what data do I need, how do I collate that data. So once that problem is solved, we get the emissions, and then we go on to our decarbonization targets or setting or carbon neutrality or whatever these jargons are, that this is my emissions, this is as compared to peers, it is, it higher, is it lower, is it on an average, is it looking like okay. um, then we go on, okay, so that is what we call, when we are able to finally get our emissions scope 1, scope 2, scope 3, we call it GHG inventorization, that we have done our GHG inventorization. So we have calculated all of our emissions across the supply chain, across like direct emission, indirect emissions, everything. We have calculated it. So it's the GHG inventorization that we have done. And now we will go on to setting targets. So that is how it works.
Thanks for that highlight.
Yeah.
Uh, So, one question that comes up or
Mhm.
has been up here, and also being a little bit mindful of the time. What ESG practice and what skills should chartered accountants, and especially the young chartered accountants, should develop so that, they remain relevant in this particular ever-growing domain?
So skill wise, I would say just first is read, because a lot is happening in terms of decarb, in terms of GHG, in terms of emission management in India, in terms of organization, in terms of policies, in terms of the carbon market that is gradually being there in the place after the notification that MOEFCC has released. Read, understand context, understand those different sources. So it's very complex when we actually go down for like decarb and emission management. um, Reading helps, understanding GHG protocol helps, and then interaction with other sustainability professionals would also help, because they are actually dealing with the challenges, dealing with different client setups, different kind of organizations, target setting exercises. They would have much better clarity in terms of how this landscape is looking like. So these are the three things which would help.
Understood. Understood.
Yeah. Next slide. So again, since we are short of time, we'll just quickly skip these slides. These are just some examples, qualitative examples um, of how decarb can take place in case you're targeting, reducing emissions and decarbonizing your operations, etc. So changing old furnaces, changing old air circulators, that also helps, because the older these, equipments are, the more emission intensive they become, because uh, they are not efficient enough if they're like 10 years older or 15-year older. So minor changes in the setup would also help you reduce emissions in the medium and short term. So these are some of the smaller initiatives that are there, changing, to CFLs, light bulbs, say CFL में shift करना, any other energy conservation activities, um, the energy efficient devices, the 5-star rating, 4-star rating devices, changing to those, switching to those can also help in reduction of emission to a great extent. Next slide. So these are all examples. Yeah, carbon credit. So basically, a very brief on what is carbon credit and how it works, etc. Basically, a carbon credit represents the right to emit 1 metric ton of CO2 or its equivalent. So these credits can be generated through projects or removal or reduction of emissions, right? Wind farm, solar installation, forest conservations. When the companies do that, then they can, possibly get into the carbon credit segment. And then companies which exceed their reduction goal can sell the excess credits. So if I have a 50% reduction target from my baseline year, and if I'm able to, through offsetting and through, solar installation, wind farms, etc., I've set up on my own. And instead of 50%, I've reduced 60%, right? So I can, that extra 10% reduction, I can sell it off in the form of credits. So that is how it is done. Um, Nowadays, plastic credits is also something because of the EPR guidelines, right? That is there in the market. So carbon credit, plastic credit, they all work in a very similar fashion. Uh, so those who, meet targets can buy credits, they can remain compliant, they can claim neutrality. So non-financial assurances take place for carbon credits and carbon neutrality claims that the companies are making. So they basically check how the offsets have taken place, how the emissions have been reduced, how solar, if they've set up some solar installation, then how the grid electricity, how it is, the consumption from grid is reduced as compared to when the solar was not installed. So assurances are also there in place to check the feasibility and verify whether carbon has been neutralized or not. And the excess can be sold off in the market in the form of credits. Next slide. So the carbon credit trading scheme in India, it basically India has rolled out this scheme through the Energy Conservation Amendment Bill, and the framework is basically centralized, and Indian Carbon Market Governing Board. So it's a board which basically governs, and there's a registry and a trading administrator there, through which proper trading, gets registered. And it makes a shift from voluntary offsets to basically a more regulated one. And it is designed to accelerate emission reduction by allowing trading of credits through like different industries and encouraging innovation as well through market mechanisms. So this is like consistently rising the carbon credit system in India, and it would be a game changer as it matures in the upcoming years. Next slide. So quickly around carbon taxation. So government also use carbon taxes to price emissions. So under this mechanism, a fixed fee is levied per ton of greenhouse gas emitted. So in various geographies, carbon taxes are actually applicable, especially in the EU. It is there's a carbon tax that is applicable. And in India, with a in India, national carbon tax is not yet in place. But globally, EU, as I said, they have a CBAM mechanism where there's a list of goods around which companies have to pay a carbon tax. So it applies to sectors which are majorly globally the higher emitters like steel, cement, fertilizer, etc. And for India, maybe it can be considered in a way that if internally there are no carbon taxes, uh, at the borders, it may be priced. So um, it's a concept where basically if you are emitting after a certain threshold, you have to pay the taxes to the government in terms of carbon tax. So it's a very basic concept, and that is about carbon taxes. Next slide. So to conclude, the need for transition to basically a low carbon economy is non-negotiable, right? With the ambitious targets that are there on a country level, it's honestly non-negotiable. And carbon disclosure is now a common thread across all ESG frameworks. So be it BRSR, be it TCFD, GRI reporting, IFRS, anything, there is, you know, uh, disclosure requirements around emission management, around reporting of emission, around emission reduction targets, etc. And it's no longer a very voluntary thing in India, and it's becoming mandatory, right? BRSR is in place. Many companies who earlier used to not track, so many tile sanitary manufacturing companies which have their manufacturing plants in Gujarat, right? There's a whole ecosystem where these companies are set up. So they earlier used to not track the emissions, the sources, the way to calculate emissions, but now BRS are in place. They are developing mechanism and system, and they're streamlining their processes. They are now understanding how emission intensive they are. So it is becoming mandatory nowadays, with upcoming regulations as well. I think it will get more stringent with the amendments and newer regulations. And it also comes with a newer opportunity as well, with new markets, technologies, and competitive advantage for the companies who are already, managing and monitoring their emissions, and who are acting very boldly in terms of changing their technologies, in terms of integrating AI in their system and processes to make them more efficient and lesser carbon intensive. And it's basically no longer a technical process, it's basically a strategic way to go about in the business and future proofing your business from basically high carbon emissions emitting into the environment. So that is all from my side, and I'd like to thank everybody for patiently listening to me. And we can now take up some quick questions which you might have.
So Shreya, we have
Ma'am,
been taking up the questions all through. Yeah. Anyone who has questions?
no, sir, no further questions.
Okay. Yeah.
Thank you, ma'am, for your insightful presentation on carbon accounting. Now I would like to request CA Harsh Shah to present vote of thanks.
Thank you for the opportunity. Good evening, everyone. On behalf of the entire team, I'd like to express our sincere appreciation to each one of you for joining us today for the webinar on carbon accounting. Your active participation and insightful questions have truly enriched today's session. I'd like to also extend a special thanks to our esteemed speaker, Ms. Shreya Kanga, for sharing profound insights into carbon accounting. Your expertise has illuminated the critical role of transparent carbon corporate reporting in quantifying and managing carbon emissions. Carbon accounting is essential in today's business landscape, as we all are aware. It also fosters transparency, accountability, and trust among the stakeholders. We believe that today's webinar has provided you with valuable insights to navigate the complexities of carbon accounting and its pivotal role in organizational decision. We encourage you to stay engaged with us as we remain committed to explore and advance sustainability practices. Our upcoming webinars are scheduled every Thursday from 4 p.m. to 6 p.m. and will further dive into various emerging themes in the sustainability. Thank you once again for your participation, and we wish you a productive day ahead. Thank you, everyone.
Thank you. Thank you so much.
Thank you, Shreya.
Thank you, everyone.
Thank you, ma'am. Thank you, sir.